Hi there, welcome to Kneppy Invest and welcome to my weekly technical and portfolio update. I'll look at the performance of three of my own personal portfolios, also give an update on the performance of the group portfolio. Haven't done that for a while. And then we'll look at some interesting charts. Focusing on companies I am paying a little bit more attention to, including quite a few beaten down companies. Now, a few of these beaten down companies I won't be following too closely, but they are the sort of companies that possibly would outperform the market when we start to see interest rates falling. Now, I'm not sure when that's going to be. It could be in a month, 6 months, or maybe a few years. But in the rising interest rate environment we have been under during the past 2 years, we have seen a few companies hit hard. And those hard times for those particular companies possibly, and that's the most important word here, possibly are coming to an end. Now, before we have a look at that technical update, let's first start with the performance of the four portfolios, three personal portfolios and a group portfolio, starting with the group portfolio. Now, 2.5 years ago, I think it was 2.5 years ago, I asked the viewers of this channel to give me about three companies that they thought would outperform the market over the following 5 years. And then I clouded results and came up with a group portfolio valued at $100,000. And unfortunately, the last 2.5 years has not been kind to this group portfolio. So this is a completely passive portfolio. There's no buying or selling of companies within this. So really just timing is the most important thing. And unfortunately, the value of this particular portfolio is down from $100,000 to $57,322. In fact, the capital loss is 20.36% per annum. Fortunately, a few dividends have come in, which means the total return is only down 18.15% per annum compared to the benchmark, the STW, which is actually up 4.74%. So why has the group portfolio performed really bad over the past 2 years? In fact, even if we look at the financial year, in fact, I haven't done this yet. In this financial year, the group portfolio is still down 8.27%. So it's not performing all that well. So why has the group portfolio performed badly, horribly over the past 2.5 years? Well, 2.5 years ago, we still had, actually, I'm just going to change that to since first purchase. So when you look at the returns listed from the best to the worst performing companies, you'll be able to see why the group portfolio has performed really bad. So the best performing companies, well, the best performed company is a company no longer listed on the ASX, being bought out, Unity Group. But after that, we have Fortescue, BHP, Soul Pattinson, BlueScope Steel, Woolworth, CSL, and then ResMed Zero. So the common feature of those best performing companies is they are the bigger companies. Companies you're going to get dividends, and also companies that are not going to fall 80 to 90% in 2.5 years. If you look at the worst performing companies, most of these are either story stocks or they've become out of favor because of the rising interest rate environment. Zip is a perfect example of that, down at 66%. Aries Resources has not performed very well, down 65%. Then we have Pointera, Imogen, Biosystems, Alcidian, EML Payments, Novonix, which was definitely a story stock, Province Resources, Brainchip, Lake Resources, and then Dust Group. Well, Dust Group and Kogan have been negatively affected by rising interest rates because of lower spending in those particular areas. Arctis, Megaport, Tesla, which has been bought out, Talga Group, then A2 Milk. So a lot of story stocks in there in the worst performing companies, and story stocks have been hit hard because of rising interest rates. In fact, story stocks will be the best beneficiary when we start to see interest rates starting to fall. So some of these companies might perform really well over the next 2.5 years. In fact, Zip is a company I am watching closely now, and the Zip share price has been running hard over the past few weeks. Now on to the performance of my own personal portfolios. Now I haven't been tracking these for 2.5 years. Well, I was tracking these for 2.5 years, but then the share site wanted me to pay some money, and then I didn't want to pay it. And then for like a month or so, I was, I think when you're not paying share site, you can only have either one or two portfolios. So I decided to maintain the group portfolio. And then I started to pay share sites fees because they came back to me and said, we'll give you a discount. And then I think I can have 5 portfolios. And so what I decided to do was track 3 of my portfolios using different strategies, quality, small cap, and technicals from the start of this particular financial year. And I just wanted to see how these particular strategies perform compared to the benchmark. And the first of these strategies is what I define as quality. So this is the quality portfolio. So this is the sort of strategy that everyone is taught to use. Find and invest in high quality companies. Now the question becomes, what is a high quality company? How you define high quality company? So there's many different definitions of that. I have my own definition of high quality company. So I want to see revenue per share increasing through time. I want to see a high return on equity, high return on invested capital, that sort of thing. There's other factors as well. If you listen to some fund managers, they'll talk about management as the first distinction between high quality and low quality company. I don't believe that. I believe it's other factors that you have to look at first. Anyway, so I do have quite a few high quality companies, what I define as high quality companies in this portfolio, not only Australian companies. Well, probably the best way to say it, not only companies listed on the ASX, but also companies listed on international exchanges, including Novo Nordisk, which is listed on the Danish stock market, one on the French stock market. Actually, that should be German stock market, I thought. And then also NASDAQ and New York Stock Exchange. But the majority of holdings is probably on the ASX. And at this point in time, the quality is outperforming the benchmark almost double. So what I'm looking for here is the quality portfolio to double the benchmark. And that's the main thing I'm looking for here is outperformance compared to the benchmark. The main reason behind that is I believe this sort of strategy can be using or investing in high quality companies can outperform the benchmark because within the benchmark, say the ASX 200, there is a plethora of really bad quality companies. And when I say bad quality companies, I include the banks. I don't think banks are high quality companies. I don't think Woolworths is a high quality company. I don't think mining companies are high quality companies. And the main reason behind that is, well, for various reasons. For instance, mining companies are price takers. Banks growth is non-existent. You won't see banks grow all that much over the next 10 years. And Woolworths won't grow all that quickly over the next 10 years. And those companies are the biggest companies, some of the biggest companies in Australia, and they take a large proportion of the ASX 200, which is one of the reasons why when you compare the performance of the Australian market, compare the NASDAQ, it's night and day. The NASDAQ is going to significantly outperform the ASX 200 simply because of the quality of companies within each. And that is why I have quite a few NASDAQ companies, not as many as I'd like, including Apple, Adobe, Amazon, Alphabet, Microsoft, PayPal, and Tesla. You might argue PayPal and Tesla may not belong in high quality just yet, but definitely Microsoft, Alphabet, Amazon, Adobe, and Apple. I'm probably most excited about Alphabet and Microsoft. Even Adobe I'm excited about because of AI. And that is going to be, over the next 5 to 10 years, I think a massive growth market or growth sector. Now, the best performing ASX companies I have in this portfolio, Commodities, Nick Scali, Breville, Domino's Pizza. Now, you might argue some of these companies are not high quality, but I will probably fight back against that. JB Hi-Fi, REA Group, PWI Holdings, Goodman Group, and then Levisa, Altium, Bayador Tech, which again is an argument against that company, which is more of sort of a company that invests in private companies. So sort of like not quite a listed investment company, but sort of like a private equity company. Corporate Travel, Aristocrat, and Fiducian Group. Worst performing company in this portfolio is Tilix, which is okay with because that's a long-term hold. Okay, so I'm happy with the performance of this portfolio, but it pales in comparison to how happy I am in the performance of my other two portfolios, which of course is small caps. Well, maybe not, of course. So the small cap portfolio consists of small cap companies, which, it's pretty obvious by the name, small caps. This is sort of my favorite space to invest in. I love finding small companies that fund managers don't want to invest in because they're too risky. And I have been fairly successful in or using this strategy in the past. And at this point in time, the performance of this portfolio is significantly outperforming the benchmark. And the benchmark here is a small odds. Even if I compare the small caps portfolio to the ASX 200, significantly outperforming that portfolio, up almost 12% compared to small odds, which is down 0.81%. The main reason there is a difference between the performance of my small caps to compared to the small odds is because I am trying to invest in maybe not quality small cap companies, but profitable small cap companies that are growing. And if you can find profitable small cap companies that are growing, you will significantly outperform the market. Now, some of these companies are not profitable. So I am sort of getting ahead of myself and investing in companies that are not quite profitable. I'm hoping they're going to be profitable in the future. Now, I could argue that probably my timing is a little bit bad. For example, Pointera is, and in fact, Pointera is the worst performing company in this portfolio. Pointera is not yet profitable. It's been on the cusp of not only profitability, but cash flow positiveness, but it hasn't quite got there yet. Now, the best performing companies in this portfolio are well over 100%. Findi, Atlas Pearls. Now, if you took a look at both Findi and Atlas Pearls, you probably would not say these are high quality companies. In fact, Atlas Pearls is a commodity-like company. In fact, not commodity-like, it is a commodity company. It is benefiting from a bull pearl market. That is why it's up over 100%. Findi is just, I think it's still significantly undervalued, up 166%. And then we have Energy One, Ansarada, Visan, Crisis Corporation, DougTech, Gentrack, Audinate, Playside Studios, Stealth Group, Catapult, Duratech, Bell Financial Group, and I think that's it in terms of companies that have outperformed my best performing company in my high quality company. In fact, I think that's Pro Medicus. And the main similarity of all those companies is they're small and profitable, and most of those companies are also growing. And then if we look at the worst performing companies, Pointera, Vection Technologies, Vitura, XREF, Integrated Research, Rectifier, SciDev, Phineas, Select Harvest, LGI. Now, a similar feature of those companies is not only have they disappointed the market, they also, many of those companies are not yet profitable. They might be growing, but not yet profitable, particularly Vection Technologies and Pointera. What else is a common feature among those companies? A lot of those companies have really disappointed the market over the past year or so. Anyhow, and you notice I have lots and lots of holdings in this portfolio, and I don't abide or follow that belief that you can only have 20 to 25 companies in your portfolio. That's absolutely absurd. If you only invest in the biggest 100 companies on the ASX, only having 20 or 25 of those companies in your portfolio, yes, I can understand why you only invest in 2025. But these are small cap companies. So the way I invest in this particular portfolio using this strategy is if I find a good company that is growing, that has the potential to become high quality in the future, I won't not invest in that company just because I have a significant amount of investments. So I have no idea how many companies I invest in this portfolio. So I don't, use that the belief that you can only invest in 20, 25 companies. It's an absurd, a myth. That's what I'm going to call it, a myth. For me, it's a myth. Maybe not for you. And finally, the final portfolio is using just technical analysis, using charts. And this has been a very successful endeavor for me. I started doing this and I started really reading technical analysis about 8 years ago. So when I first started investing, I was all about finding really good quality companies good value. And then I start, because I'm very open-minded, quite curious, and in my opinion, it's very important to be open-minded, not only investing, but in life itself. And I started learning about technical analysis because I wanted to know if there was something or some truth to it. And then I started to see, things that was quite obvious. For instance, the very first technical trade I made was on a company called M2 Communications, which is no longer listed on the ASX. Share price of that company was going sideways. The PE ratio of that company was a telecommunications company, and the PE ratio at the time was like 14. I was like, why is the share price going sideways when this company is significantly undervalued? And then one day the share price popped up out of this consolidation period on high volume. It rose 4%. I went, oh, I've seen this before in one of my technical books. And I took a position and the share price just went on a massive rally. And then I sold for a profit of like 30, 40%. And then I think the next company I bought was Fortescue. There might have been some others in there. Fortescue at $3 because it broke out. And that went from $3 to current share price of 25. And there's been other stories else in there. And I've just seen over and over again that technical analysis does work. I don't believe in those people who say technical analysis is just like astrology, that sort of thing. It's just all made up gibberish. It's wrong. There is a reason technical analysis works, and it's all to do with human psychology and also mathematics. So if you believe in human psychology and mathematics, then technical analysis should make sense. Anyway, and the reason I started tracking this particular strategy in this portfolio is I just wanted to see if I'm suited to technical analysis. And at this point in time, yes, I am. So this portfolio is up 18.26% compared to the benchmark, which is the STW, up 2.32%. Now, I'm just going to show you the companies that I'm currently invested in. So even these, just open positions, up 11.49%. So this does not include those companies I've taken profit. So not a lot of holdings in this portfolio right now, and I might change that in the next few weeks. Only two companies down, Reject Shop and Vista Group. Vista Group was a mistake. It's illiquidly traded, and I am making some rules up. And one of the rules is in this particular portfolio, this is not a rule I'll use in my other portfolio, the small caps, is I want shares to be liquidly traded. I need shares to be liquidly traded. And if the share price of a company is down 10%, I will sell, automatic sell. Anyway, so step one, the best performing company right now, up 64%. And then we have MA Offshore, Dicker Data, Service Stream, Hub24, Phoenix, which is a position I've taken recently, Email Payments, another position I've taken recently, James Hardie, GD Holdings, Mass Group, and then the Reject Shop, which is probably the closest company apart from Vista Group that I will be selling out of soon. So the main feature of this is I want to see companies' share price rise. If the share price rises, I'll maintain a holding. If the share price falls to 10% down, then I'll sell. That's why this sort of strategy can and should work. Ride your winners as far as possible. Sell out of your losers. That strategy mathematically actually should work, and you should be able to beat the market quite easily, in fact, I believe. And that's at this point in time, I am significantly outperforming the market. 18 up 18.26%. We're not even halfway through the financial year. So I could sell all these positions and significantly outperform the market over the full financial year. Okay, now on to the technical update part of the video. Starting with the indices. So people are getting a little bit excited that we're in a Santa rally, that sort of thing, even though the XGO is still going sideways. We have a nice little rally since the end of October. So we're talking about a month and a bit of a rally. But we've had these rallies before over the past year and a half. We've had some really good rallies. In January of last year, the XGO went from just under 7,000 all the way up to 75.60. We've forgotten about that. We've had some nice little rallies in March, a nice little rally in July, and all those rallies came to an end. So even though we've had a nice little rally in the past month or so, it doesn't mean this is a bull market. It doesn't mean this is a Santa rally. We might see it come down again. We just don't know. There's no trend at all in the XJO right now. Well, so I'm just going to say medium or long-term trend. There is a short-term trend, but these short-term trends don't last very long. And we've seen that time and time again over the past two or few years. The XSO has been in a long-term downtrend. It's still in a long-term downtrend. even though we've seen a nice rally. In fact, the XSO right now is in a vulnerable area. It's in a resistance zone, which is the longer term moving average. If we continue to see the XSO rally, which is possible, particularly because we've seen a little bit of change of sentiment when it comes to small caps, because possibly we're at the top of the interest rate cycle. And if that is true, then possibly we'll see small caps continue to rally. But the other side of the coin here is one of the reasons why we might be the top of the interest rate cycle is because of economies tanking. The economy is slowing down. The economy is going into recession. And if we do go into recession, just because interest rates start to fall doesn't mean the stock markets will go on a rally. In fact, I have shown you this before time and time again. During recessions, even when interest rates fall, we still see markets fall as well. There's a positive correlation between interest rates falling and stock markets falling. So don't get ahead of yourself. Just because interest rates might fall doesn't mean the stock market will go on a rally. It's a false belief. But again, if we have sort of a really soft landing, if we do start to see inflation fall, unemployment doesn't rise, and GDP continues to increase, and then if we do get that soft landing, then possibly the stock market will go on a rally. There is that scenario at play. Just don't believe 100% that because interest rates will drop, we'll start to see rallies in the stock market. It's not necessarily true. It all depends on whether we go into recession. So Australian markets, boring. American markets, though, look pretty good. NASDAQ looking nice, a nice little rally. This is an uptrend still. Russell 2000, which is, for those who don't know, there's Russell 3000. So that's a combination of the New York Stock Exchange and the NASDAQ. So it's sort of like the three biggest companies in those. And then the smallest 2,000 companies is a Russell 2000. So this is a small cap sort of indice. And this has been traveling very similar to, this is probably most similar, I'd say, to the XJO. So no trend. If there is any trend, it's actually down. But we have seen a really good rally in the Russell 2000 since the end of October, just like the XJO. And that's off a nice, you can see it rallying off a support level around about 1,660. It's actually rallied quite nicely. And then the Dow Jones, this is actually looking pretty bullish as well. Dow Jones is in an uptrend, a short-term uptrend. And the last time the XJO was this high was back in late 2021. So the XJO is moving towards all-time highs. Not far off all-time highs, the Dow Jones. The all-time high was in early 2022 at 36,952. So the Dow Jones is not far off that, 36,248. Okay, that's all I'm going to talk about when it comes to indices. So some are looking pretty good. NASDAQ, American indices look pretty good right now, particularly Dow Jones and NASDAQ. Australian indices, going sideways. Sort of like a crab crawl to the left or to the right. Now onto indices, or not indices, commodities. So at the end of last week, gold is looking bullish. What's happened to gold? Oh, it's a false breakout. I think I mentioned this in the week that was. Not only that, the last day of trading, so on the Friday, gold was down 1.2%. It's actually a really bad week for gold. So on Monday, what was Monday? Yeah, on Monday, the volatility in gold was extreme. The high on Monday was 2,146.79, which was well above the support level, and then the selling came in. Selling came in a lot. In fact, gold from the high to the low, and the low was at the end of trading on Friday almost, gold was down 6.6%. This is a definition of a false breakout. And you can see that if you just look at the 5-minute trading. So let's have a look at the 5-minute trading. You can see exuberance in gold. You can see it here. Look at that. Look at the exuberance in gold. So there was, on Friday last week, there was a lot of volume coming in. Actually, that's a Saturday. Volume coming in. The share price or the gold price looked like it was breaking out at 3:50 a.m. Saturday. And then on Monday, in the first bit of trading, gold took off. In fact, gold prices in the first about 30 minutes of trading on Monday went from 2,073 to a high of 2,144 because it looked like gold was breaking out, but that was a false breakout. And then the selling came in and gold bounced off the support level, so resistance can be support. At this point in time, it did look like possibly the old resistance level had become support because we saw a bounce at 6 p.m. on Monday. Saw a nice little bounce, but the bounce was weak, very weak bounce. And then we saw gold price struggled, and then gold fell through that support level at towards midnight on Monday, and that's it. That was a false breakout. So gold only remained above the old resistance area or level for not much time. It's about a day of trading, and gold has continued to fall. Anyway, so that has affected some gold companies. And if you look at the long-term chart here, we had a very similar, not quite as extreme, false breakout last time. Gold tried to get above the old support resistance level back in May of this year. So now, 1, 2, 3, 4 times gold has tried to break above 2060, and it's been a false break. Now, if we see gold get down to 1,600 or so, that would be a support level. I wouldn't be surprised to see, because generally gold is going up, so I wouldn't be surprised to see gold break out in the next month or so. I think this, even though this was a false breakout, there's still some positive sentiment in gold. And the other thing to take into account, gold is the place to be historically when interest rates drop. So again, there is a negative correlation between interest rates dropping and gold prices. So gold prices rise as interest rates fall. So possibly gold wants to break out, and maybe that's why gold was trying to break out, because of that negative correlation between interest rates and gold. Now, you probably could actually argue, why was gold so hanging tough if it's over the last 2 years when interest rates were rising? That's a good question. Iron ore. Iron ore looks really good. Look at the beautiful iron ore chart. So there was a nice little resistance level at about, we'll say $130. And iron ore was struggling to get above that. It took about 2 weeks to get above it. And then as soon as, actually, if you zoom in, you can see between Thursday, the 30th of November and the 5th of December, so iron ore, every single time it fell below $130, we saw some buying coming in. And then when the buying had stopped, well, not the buying, the supply of iron ore had come to an end, we saw iron ore rally. Look at a rally over the last 3 trading days. That's because supply had come to an end. So pretty good volume coming in, although if you look at the volume, there's always spikes in volume, so there must be a reason behind that. And most of those spikes looks like it's on a Thursday or so. So anyway, iron ore looks really good right now. Uranium still looks good, keeps going up. But I think what I did here was the market is assuming that uranium is at $100 a pound. And that is when you look at the value of iron ore or uranium companies on the ASX, possibly even in the world right now, it's an assumption that uranium price is at 100 pounds. So that's probably one of the reasons why a lot of uranium companies' charts are quite different than uranium. So you can see the sort of an exponential rise in uranium since about July, but you don't see a similar thing in uranium prices. For instance, BOE, which is Boss Energy. Well, I suppose there is, but yeah, there is. If you look at July, there was that initial run up, but then there's sort of a pullback in Boss Energy. What if palladium is the same? Oh, sort of, yeah. Well, I know what one isn't. It's Peninsula. Peninsula. Yeah, that's complete opposite. Yeah. Maybe it's time to think about Peninsula. I don't know. Okay, oil. Oil. Oh, look at oil. So we have seen a little bit of bounce in oil in the last few days. Has the low been hit? Now, if it is, maybe now is the time to think about Karoon, Santos, Woodside, those sort of companies. And I am actually interested in Karoon, trying to catch a bounce on US oil or just oil. Lithium, I don't know why lithium companies have rebounded in the last week. We saw Pilbara rally significantly. It looks like it broken through support, then it just bounced. Latin Resources share price rose 30%, but when you look at lithium prices, it keeps on going down. So there's sort of a disconnect there. Maybe this chart is wrong. Maybe it's delayed a little bit, but lithium prices, of what I've seen, still going down. Maybe it's just people think lithium companies are really good value right now, but if lithium prices keep on dropping, yeah, that's all I've got to say. I think there is an argument eventually that lithium prices will start to level off, but that leveling off there's no end in sight to the drop in lithium prices. Copper was looking good the last time I looked. A little bit of a correction. So no real trend in copper right now. So let's go on to coal. Coal has had a little bounce. And I think that's all I'm going to speak to when it comes to commodities. Now onto Bitcoin. Bitcoin, oh, look at Bitcoin. That's beautiful. Bitcoin looks beautiful right now. So this is what I wish gold would look like, but I do have a little bit of Bitcoin just for the thesis that eventually Bitcoin will become, and this is a possibility that is of low probability. So like a 1% probability that eventually Bitcoin becomes the what do you call it? The reserve currency. There is that scenario eventually that Bitcoin will become a reserve currency. Who knows? 1% chance. But if it does become a reserve currency, Bitcoin would be significantly higher than it is now. But beautiful chart. So just technically trading Bitcoin, you probably would be doing fairly well right now. And finally, bonds. So yeah, I'm just trying to see if there was a relationship between Bitcoin and bonds. Not quite. Is there a relationship between gold and bonds? Sort of. Not quite. I was just saying if the bond yield highs correlated to the gold lows. Not quite. So bond yields have fallen. They fell through the previous resistance level. We have seen a little bit of a bounce in bond yields the last 2 days, but yeah, bond yields have fallen a fair bit from this is a 30-year, US 30-year, from 5.1% to 4.2%. That is a fairly big drop in about a month. So it's not surprising to see a bounce right here. But again, this is probably a reason why to pay particular attention to those companies that would benefit from decreasing interest rates, because I think what the bond market is saying is they do expect interest rates to drop start dropping within the next year. And of course, the Australian 10-year has a very similar pattern. And of course, the TLT, which is the 20-year Treasury bond ETF, beautiful rally, but still the TLT is right in a resistance zone, which is the longer-term moving average. And whenever the TLT gets into that range in the past, it flounders, it pulls back. So anyway, that's all I got in regards to indices, commodities, Bitcoin, and bonds. Let's have a look at individual companies. I have about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. I'm going to get rid of Google. Not sure why Google's there, or Alphabet. So about 12. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So these are companies I am either following closely, or there is a few companies here that are more than likely will never buy, but these are the sort of companies to maybe keep an eye on in the future. So Cobram Estate, I have actually shown you this chart a few times in the past, maybe month or so. This is a possible breakout. We have seen the Cobram share price rally in the past 2 days, up 3% and then 2%. And the share price of this company is now at a 1-year high. And it does look like the share price is moving into an uptrend, and sentiment in this company is shifting. No news flow that I can remember from this company. It's just a shift in sentiment, shift in trend, the share price. So this is a possible technical analysis or technical trade I will make in the next few days. If I see the share price pull back to, say, $1.42, that would be a nice little buy-in price. So I'll just put a little line here. The reason I was thinking of buying that is that's because It was struggling to get above that level for a long time. We've seen it break out above that level. And then if it pulls back, tests $1.42 and then takes off again, that will be a really good sign moving forward. Now onto a controversial company, Zip. So this is definitely a company I put onto my watch list. One of those companies that really could benefit from falling interest rates. You could put also Sezzle, Split It, maybe Hum, those sort of companies. There's a few other companies I will also include, but I'll talk about those companies a little bit later on with Money Me. But Zip, a huge volume coming in the last few days, massive volume coming in. Share price is trying to break out. Last time share price was this high was May. So we are talking about a 6-month high in Zipco's share price. But it's the volume. Now, we had some, if you go back to July 2022, like this rally in the share price, that was just a dead cat bounce, even though there was a large volume. We've had similar little rallies back in January of last year, but that was just, I don't know what that was. But this is a first sign. I think there could be a potential rally in Zip share price, and there's reasons behind it. So I think possibly the market is getting a little bit too ahead of itself, but this is a sort of company I would definitely have on my watch list for a sneaky buy. Sneaky, taking advantage of falling interest rates. Definitely Zip should take advantage of that. Another group of companies that should take advantage of falling interest rates, if they do occur within the next year, are REITs. Here's one. And this is actually the first REIT I started following just because it was the first company to release their results a few years ago. Convenience Retail REIT, or Dexter's Convenience Retail REIT, DXC. And we have seen a rally in the share price corresponding to yields. Come on. It's waiting. It's not updating. Hello? Anybody home? I have no idea what's happened. Let me just pause here. And I have no idea what happened. I just had to refresh the page. So let's have a look. So Texas Convenience Retail hit a low on the 31st of October. Share price hit a low of $2.21. Now let's have a look at the 30-year bonds. And that high was around about the 31st or the end of October. So definitely can see a correlation between bond yields and REITs. And this is one REIT I'm following. There's plenty of other REITs, Charter Hall Long, Whale, CLW. There's industrial REITs, retail REITs, office REITs. There's a plethora of REITs. And definitely, if we do see bond yields drop or continue to drop, interest rates falling, REITs is possibly a place to be. And that's why the share prices of many of these companies have rallied. Now, they have rallied before. So is this a sustainable rally? Remains to be seen. But definitely, I do have a few of REITs on my watch list. I currently own Goodman Group, which is sort of like a proxy REIT. I don't necessarily believe Goodman Group should be classified as a REIT because it's a little bit more than just a plain REIT. But definitely plain REITs, ordinary REITs like Dexter's Convenience Retail, some companies to put on your watch list in case of interest rates dropping. Now, not necessarily a company to have on your watch list, but I noticed MAF Financial Group, which is a company I do like, is at a really important level. Why is $5.50 a really important level for MAF Financial Group? So it has really struggled to get above this level in the past year, in 2023. So it got to this level in February, it got to this level in July and failed and then pulled back. So it's right at this level. So this is a possible breakout in the future. If we see the share price get above $5.50 on really good volume, MAF Financial, I will call it, it is breaking out. So your share price was in a downtrend during 2022, and it looks like now downtrend has come to an end. Now the share price is going sideways. You can see sort of a wave-like function or pattern in the share price, and this is just short-term sentiment. Short-term sentiment tends to be wavy. And right now, what could change that short-term sentiment is the share price of this company breaking out, preferably on really positive financial news. So a company I definitely have on my watch list in case of that breakout. Another company, now this is a perfect example of a potential breakout. Now, this is not necessarily a company I will buy, but I maybe should not ignore this because Adore Beauty is sort of a company I would never think would be highly successful, and sort of, you can see the share price has absolutely tanked since it listed on the ASX, but definitely a long-term downtrend, and possibly the long-term downtrend has come to an end and a possible shift in sentiment. There was a failed takeover bid when management said the takeover bid was really undervaluing the company, but the share price rallied even though it was failed because the market went, oh, if management thinks this company is undervalued, if there was a takeover bid for this company, then definitely you have to say this company is undervalued. And what fascinates me about that is the share price just went sideways. So not a lot of selling coming in, and the share price is going sideways on the old highs we saw back in August, which is another good sign. So if the share price starts to go up, that would be a good sign that those who want to sell, those shareholders who had bought in the past, who have wanted to sell, have had the opportunity to sell, and they're now out of the share registry. And maybe there's been a bit of a turnover in share registry. The one thing I'd like to see is a little bit higher volume, but definitely a potential breakout when it comes to Adore Beauty. Another sort of pattern I'm looking for is when you start to see volatility start to go lower and lower. So if you use Bollinger Bands, you'll be able to see that if you do use it. You can just see this with Domino's Pizza. Share price of this company is just going sideways for the past, we'll say, 4 months. So it's not a long time, but definitely going sideways. And when you look at the 2 moving average envelopes I have here, so longer term moving average, shorter 2 moving average, they're coming together as well. So volatility is sort of decreasing. Now that's important because day traders, short-term traders love volatility. So when they see lack of volatility, they're not interested in the company. So what I'm waiting for when it comes to Domino's Pizza is some sort of news flow. If not news flow, I'm waiting for a breakout of this consolidation period. So the breakout would be, say, the share price increasing 6% to say $58 or something like that, which would be more than 6%. Or a breakout could be to the downside. So what I'm waiting for here is a breakout either way. And if I see a breakout to the upside, I will consider trading Domino's Pizza, particularly if the breakout is on positive financial news. There was some positive financial news from this company in August when they released results. Share price increased 11.8% on the back of that financial report. And I think the market might be just waiting for confirmation that things have become positive or Domino's Pizza have turned things around from February of this year when the share price absolutely fell off a cliff. Another possible breakout is Beacon Lighting. I had this come up as I went through quite a few charts. Look at a nice little rally in Beacon Lighting share price. I don't know much about this company, apart from they sell lighting, light fixtures, that sort of thing. But you can't discount this sort of rally in the share price. Now, the only reason you could discount it is the volume. Volume has been fairly weak. So I'm not sure don't remember any positive announcement from this company. But if you are getting excited about this, all you have to do is draw a line from the last high to where it is now. So the share price right now is at the last highs we saw back in January. So even though share price is almost at a 1-year high, there's still some shareholders who bought in higher prices who might be a little bit of resistance. They might see the share price rallying to $2.40 and they think, oh, I can now sell my Beacon Lighting shares not at a loss. So maybe some extra supply on the market when it comes to Beacon Lighting. But anyway, this is what I'm looking for. Potential breakouts. A company I do own, Bell Financial Group, and I think this is breaking out. I did actually feature this company in a recent video because the share price was trying to break out above $1.12, which is the highs we saw back in December last year and February of this year, I mean. And if the share price got above that, that would constitute a breakout. And it got above that level on the 1st of December and then really took off on the 4th of December. So this is exactly what I'm looking for. This sort of pattern, share price in a long-term downtrend and the share price starting to turn up, sort of like moving into an uptrend. Sentiment in this company is shifting. And about time, because the reason why the share price sold off was because of money laundering concerns. And then ASIC said, you have nothing to be worried about. Nothing to be worried about here. And to be fair with you, if there was nothing to worry about, the share price should be back up towards $1.50 or even higher. So there is definitely value when it comes to this company. That's why I am now holding Bell Financial Group. Another pattern I'm really interested in another company I'm trading right now, is the Elders. So Elders, long-term downtrend. It's been a downtrend, a definite downtrend since November last year, so over a year. And then they released their financial report on the 13th of November. Share price increased, what was it, 18% on that day. But look at the shares been doing since then. They've also paid a dividend as well. Share price just going sideways. This is really good. When you see the share price just going sideways, that's a good sign. That means the demand and supply are in balance. And that's really good for a company that's been in a downtrend. That means there's not extra supply of shareholders wanting to sell out. Or if there is, that it's being met by demand of shares. So what I'm waiting for now with Elders is a breakout. So not a breakout, but I want to see the share price start to go up from here. I don't want to see the share price go lower. I want to see the share price go up. And that will be a positive sign moving forward for Elders, particularly because I'm trading it. Now, another company, so last three companies are definitely companies or the type of companies to focus on. The next company is Money Me. So look at this chart, a horrible chart. So Money Me is a lender, a non-bank lender to, I think, sort of enterprises. What do they call them? SMEs, BMEs, that sort of thing. No, not BMEs, small to medium enterprises. Yeah, SMEs. And companies like Money Me have been hit hard. So this company's share price has fallen from $2.40 to 7 cents. So other companies like Money Me include Plenty, Prosper. So I'm talking about non-bank lenders, Resimac, maybe even Judo Capital. There's a plethora of them out there. And one of the reasons I'm looking at Money Me is the valuation of this company is really low, 56. So in a way, the market is pricing failure. But the share price, if you just get rid of the moving averages, because share prices have fallen a lot, we'll keep in the 150-day moving average. Share price has been going sideways. The company did a massive capital raising, I forget when, about 6 to 9 months ago. But look at what happened to the share price in the last few weeks. So definitely the decreasing bond yields has positively affected Money Me. Share price of this company has increased from 4.8 cents to 7.1 cents. So almost a 50% rise in share price. Some good volume coming in on Friday of last week, previous week, and Monday. Share price of this company rallied 17%. And then 13% in consecutive days, and then has gone sideways. So that sideways pattern after a nice little rally is really interesting. So possibly the bottom has come in for Money Me. Now, if you listen to, say, Ausbiz The Core, this company has been raised a few times with Luke Winchester and Claude Walker, and they hate these sort of companies. And that makes me like these sort of companies, not because I don't like them, but there's such negative sentiment in these companies that I think they are way or possibly way undervalued. My only concern is the long-term, maybe not long-term, but the short to medium-term viability of some of these companies. But I think some of these companies will make it, and if they do make it, they are really undervalued right now. And I think there is a chance that some of these companies can rally significantly in the next few months, particularly if we continue to see bond yields falling and interest rates start to falling as well. Now, my last two companies in this video, and these two companies I more than likely will never buy, but these are the sort of companies that will benefit. I'm not saying these two companies will benefit, but the sort of companies that will benefit from decreasing yields and decreasing interest rates. And they are Dubber and Live Tiles. We haven't seen a rally in either of these companies recently. So the market doesn't care. Now, the problem with both of these companies is they have been burned, particularly Dubber, been burning through so much cash. And those sort of companies, unprofitable companies, burning through a lot of cash, have been hit hard. So these are the type of companies that could benefit from falling bond yields, falling interest rates. Those companies that are burning through a lot of cash. Unprofitable, burning through cash companies like Dubber. And Dubber's market cap In fact, I've got it here. Daba's market cap has dropped from $1.1 billion in 2021 when no one cared. This company was burning through cash. They had really good growth in revenue. That's the only thing the market cared about then. So it's fallen from 1.1 billion to 50 million. I think it's 50 million, around 50 million right now. But at this point in time, the market just doesn't care about these companies. No rally yet for Daba. But just because there's not a rally yet, and there is and probably good argument would say that these are going to be the last companies to benefit from a rising, falling interest rate, falling bond yield scenario, because these are the last companies that would be on, these companies will be in the bottom of anyone's watch list, put it that way. So I'd probably prefer MoneyMe, Zipco, those sort of companies, and those companies have already rallied. And eventually, when those companies rally a lot, it'll be these companies where attention will be adverted or diverted to those companies that have yet to rally. And then look at LiveTiles. LiveTiles, 0.5 cents, insane. At one point in time recently, when I say recently, I'm talking about in terms of years, the share price of this company was 75 cents. So the share price of this company has dropped 99 point something percent since, well, 2018. Share price of this company got a high, its high was in 2018. And at that point in time, get rid of Daba. The market cap of LiveTiles reached a high of 350 million in 2019. Current market cap of this company is $6 million. Hoping no one has owned this company or even Daba since the market cap high. Anyway, so those are two sort of companies that could benefit long term from falling bond yields, falling interest rates, because these companies have been hit hard because of rising interest rates. And it all comes back on how long until these companies become profitable. So this is the reason why these companies are hit hard during a rising interest rate environment, because if their profits are not until 10 years in the future, you have to give a bigger discount to their future profits. Hopefully that makes sense, because the future cash yields based off a high interest rate environment, those future cash yields, those future profits are significantly worth less today because of inflation, that sort of thing. Anyway, that's all I've got for today's video. If you have any questions or maybe any other examples of companies that could benefit from falling bond yields, falling interest rate environment, I'd love to hear your companies, list of companies. There's probably a lot of companies out there, but maybe another sector, a sector that I have ignored in today's video. So leave those thoughts in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.